Today we're answering the question at hand, why invest in private credit? By the end of this video, you'll not only understand how private credit generates consistent 12% annual returns in volatile markets, you'll also discover how to capitalize on a $1.7 trillion investment opportunity that traditional banks can no longer fully serve.
One of the nation's top real estate investors. Within only 7 short years, Dave Seymour has transacted millions of dollars of real estate and has become one of the nation's leading experts in both residential and commercial transactions.
Look, money loves clarity, and what I'm about to share with you has quietly become one of the most powerful wealth building tools that most people have never even heard of. For years, wealthy and sophisticated institutions have been using this investment strategy to generate consistent returns while traditional markets swing wildly up and down. And the best part is that it isn't about timing the market, picking the next hot stocks, or gambling on cryptocurrencies. It's about something far more fundamental, being the bank. You see, everyday successful businesses need capital, not the Silicon Valley startups looking for their next billion-dollar valuation, but established companies with real assets, real cash flow, and real customers. These businesses need loans for growth, for expansion and operations, but banks aren't always eager or able to provide these loans, even to healthy companies with strong financials. In fact, according to recent market data, traditional banks now account for less, listen to this, than 20% of middle market lending, down from over 70% pre-2008. So this creates a massive opportunity that savvy investors have been capitalizing on through private credit. Think of it as cutting out the middleman. Instead of putting your money in a bank that lends it out and keeps most of the profit, you become the lender, capturing those attractive returns, if you will, for yourself. What makes this particularly compelling is the range of high-quality borrowers in this space. We're talking about successful developers, large private companies, family offices, and businesses backed by substantial assets from commercial real estate to agricultural properties. These borrowers often prefer private credit over traditional bank loans because of faster approval processes and more flexible terms, even when they're willing to pay premium rates for that efficiency. The private credit market has exploded from $375 billion in 2009 to over $1.7 trillion today. And while that growth is impressive, what's truly fascinating is why it happened. And it all goes back to 2008. Remember, when everything we thought we knew about banking changed? You see, after the financial crisis, regulators cracked down on traditional banks, forcing them to maintain higher capital reserves. These new rules made it harder for them to make certain types of loans, even to healthy businesses. This created what investors call a structural opportunity, which is a gap in the market that isn't just temporary, but built into the very system itself. The gap became a golden opportunity for private lenders to step in. Take BlackRock's direct lending platform, which has grown from $10 billion to over $85 billion in private credit assets since 2018 alone. And unlike the volatile world of stocks or the meager returns from bonds, private credit offers a potential for high, steady returns with built-in protections that most investments simply don't have. And what makes them particularly interesting right now is that we're entering a period where traditional investment strategies are being challenged, and challenged hard. The 60-40 portfolio that worked for decades, well, it's showing cracks. Bonds aren't providing the safety they once did, and the stock market, well, let's just say the easy money era might be behind us. Now, meanwhile, according to Cliff Waters' Direct Lending Index, private credit has delivered average annual returns of 12% over the past decade, with significantly less volatility than high-yield bonds. But how exactly does it achieve it? Well, the answer lies in a unique combination of features that most investors, well, they've never even considered. And while the super wealthy have been using this strategy for years, recent changes have made it accessible to a much broader group of investors. What's particularly fascinating is how private credit actually becomes more attractive in challenging economic environments. When banks pull back further, when interest rates are uncertain, or when markets are volatile, These are precisely the conditions where private credit can shine its brightest. But to understand why, we need to look at three key elements that make this investment strategy so very powerful. The first key element is security. Unlike investing in stocks where you're at the mercy of market sentiment, private credit deals are typically backed by real, tangible assets. We're talking about commercial buildings, industrial equipment, or agricultural land assets that you can see and touch. This isn't just about having collateral, it's about having a first claim on that collateral through registered first mortgages and senior secured positions. But the real magic lies in the second key element, which is how private credit generates returns. While traditional fixed income investments might leave you vulnerable to market swings, private credit, well, it operates differently. These loans often come with floating rates, meaning when interest rates rise, so do your returns. It's a natural hedge against inflation that's built right into the investment structure. In 2023, major private credit funds reported average yields between 10 and 12% as they benefited from higher base rates. Think about that for a moment. While other investors worry about how rising rates might hurt their portfolios, private credit investors can actually benefit from such changes. This is why institutional investors like pension funds and endowments have increased their allocations to private credit by an average of 12% annually over the past 5 years, because it provides a level of portfolio resilience that's hard to find elsewhere. The third key element usually makes investors nervous, but it actually works to your advantage in private credit, and that is reduced liquidity. Now, while public bonds and stocks can see their prices swing dramatically based on short-term trading, private credit operates differently. The reduced price volatility actually allows managers to focus on what really matters, which is the fundamental quality of the loans and the underlying assets. Moreover, private credit offers something that's become increasingly rare in today's investment landscape: a predictable income. These aren't speculative returns based on hoped-for capital gains. We're talking about contractual payments, typically distributed monthly based on interest rates and the fees that are agreed upon up front. The sophistication of this market runs deeper than most realize. Private credit managers don't just write checks and hope for the best. They employ extensive due diligence processes, analyzing factors like the asset type, the loan purpose, location, independent valuations, and loan-to-value ratios. This isn't about taking unnecessary risks, it's about understanding and managing risks in ways that traditional lenders often can't or even won't. Now, what's particularly compelling is how private credit managers can often provide something that banks increasingly cannot, which is flexible, tailored financing solutions. Let me say that again: flexible, tailored financing solutions. This isn't about checking boxes on a standardized form. Instead, these managers can create custom lending solutions that work for both the borrower and the investors. Think about it this way. When a company needs financing, they essentially have three choices. One, they can go to a bank if they can get approved, issue bonds in the public market if they're large enough, or they work with private credit lenders. Each time traditional financing becomes harder to access, private credit becomes more valuable to businesses and potentially more rewarding for investors. Think of private credit as a well-oiled machine with multiple gears all working together. The borrower gets their needed capital, while investors receive monthly income distributions. But what makes this machine truly remarkable is the built-in safety mechanisms. Instead of relying solely on a company's promise to repay, private credit typically comes with something far more concrete, which is specific covenants and protections written into every deal. This is where the expertise of private credit managers becomes crucial. These aren't standardized loans that get rubber stamped through an automated system. Each deal undergoes thorough review, considering factors like the asset type, the loan purpose, location, independent valuations, loan terms, and the all-important loan-to-value ratio. It's a level of security that helps protect investor capital while still delivering attractive returns. But let's address something that might be on your mind: the relationship between risk and return. There's a common misconception that higher returns always mean higher risk. Look, while that's often true in public markets, private credit operates under a different dynamic. The premium returns in private credit don't come from taking excessive risks. They come from providing solutions to borrowers who are willing to pay for flexibility and speed. Think about what happens in the commercial real estate market, where private credit has become increasingly important. But when a developer spots an opportunity, they often can't wait months for traditional bank approval. They're willing to pay a premium for quick, reliable access to capital. This creates an opportunity for private credit investors to earn high returns without necessarily taking on higher fundamental risks. This brings us to another fascinating aspect of private credit: its behavior during market stress. While public markets can see wild swings based on sentiment and trading flows, private credit's structure allows it to potentially weather most, if not all, storms differently. The direct relationship between lender and borrower, combined with strong security positions and regular income payments, well, that creates a different kind of resilience. But perhaps one of the most compelling aspects of private credit is its role in portfolio diversification, and this doesn't get talked about nearly enough. Traditional portfolios typically rely on stocks for growth and bonds for stability, but today's environment, these correlations between stocks and bonds increasing, finding truly diversifying investments has become a lot more challenging. You see, the power of private credit as a portfolio diversifier becomes even clearer when you look at how it generates returns. The power of private credit as a portfolio diversifier becomes even clearer when you look at how it generates returns. You see, unlike stocks, which rely on company growth and market sentiment, or bonds, which are heavily influenced by interest rate movements, private credit creates value through direct lending relationships. This fundamental difference is how returns are generated that help explain why private credit can perform differently from traditional investments. What's particularly intriguing is the evolution of the private credit market itself. We're not just seeing growth in terms of size, we're seeing sophistication in how deals are structured, how risks are managed, and how investor interests are protected. The market has moved far beyond simple direct lending to encompass a wide range of strategies and opportunities. The sophistication shows up in how private credit managers approach different types of lending. Some focus on sponsor-backed deals, for example, working with private equity firms and their portfolio companies. Others specialize in non-sponsor lending, working directly with businesses and property developers. Each approach has its own advantages, and understanding these nuances is crucial for investors. Something that might surprise you about private credit is the importance of what doesn't happen. In public markets, success often depends on making the right moves at the right time. In private credit, success often comes from what you choose not to do, which loans you decide not to make, and which risks you choose not to take. The best managers understand that protecting investor capital starts with saying no to the wrong opportunities. This disciplined approach becomes even more important when you consider how private credit deals are structured. You see, unlike public bonds, which typically have standardized terms, private credit agreements can be customized to include specific protections. Now, these might include financial covenants, collateral requirements, and other provisions that help protect investors' interests. The timing for understanding private credit couldn't be more relevant. As traditional fixed income continues to face challenges and market volatility remains elevated, investors are increasingly looking for alternatives that can provide both attractive returns and meaningful protections. One of the most powerful aspects of private credit is its emphasis on active management. Unlike buying a bond and holding it to maturity, private credit managers actively monitor their loan portfolios. They maintain ongoing relationships with borrowers and can often take proactive steps if issues are arising. This hands-on approach, combined with strong legal protections, helps explain why experienced private credit managers have been able to deliver consistent returns through different market cycles. But what really sets private credit apart is the alignment of interests it creates. When a private credit manager makes a loan, they typically plan to hold it to maturity. They're not looking to trade it in or trade it out based on market movements. This buy and hold approach means their success is directly tied to making good lending decisions and carefully managing risks. The opportunity in private credit becomes even more fascinating when you look at the different strategies available within the asset class. Just as a chef has multiple techniques to create a memorable meal, private credit managers can employ various approaches to generate returns while managing risks. Take real estate bridge lending, for example. These are typically shorter-term loans that help provide owners or developers navigate crucial transition periods. Or we could consider asset-based lending, where the focus is on businesses with strong collateral, but perhaps complex cash flow situations. You see, each strategy requires its own expertise, and the best managers know exactly where their strengths lie. This specialization in private credit is crucial because it affects everything from how deals are sourced to how risks are assessed. Some managers excel at working with private equity-owned businesses, while others have built deep expertise in dealing directly with business owners and entrepreneurs. You see, the key to understanding that these aren't just different flavors of the same thing. Another could be seeing increased opportunities. You see, this dynamic nature of the market means that skilled managers can adjust their focus as conditions change, always seeking the best risk-adjusted returns for their investors. And at the same time, what's fascinating about these different strategies is how they can complement each other within a private credit portfolio. Just as you wouldn't want all your stock investments in one sector, different types of private credit can provide additional layers of diversification. Some loans might be shorter bridge term financing, while others could be longer term facilities for business expansion, for example. Now, the key is understanding how these different strategies perform in various economic conditions. During periods of growth, development, and expansion, loans might take center stage. In more challenging times, rescue financing and special situations can become particularly attractive. It's this flexibility to adapt changing market conditions that makes private credit such a dynamic investment strategy. But perhaps what's really intriguing is where private credit is now headed. As traditional banks face continuing regulatory pressure and capital constraints, the opportunity set for private credit keeps expanding. We're seeing innovation in deal structures, the emergence of new lending niches, and increasingly sophisticated approaches to managing risk and return. Think about the growing importance of sustainability and ESG considerations. Private credit is uniquely positioned to support the transition to a greener economy, providing financing for everything from renewable energy projects to sustainable agriculture. These aren't just feel-good investments. They represent real opportunities to generate attractive returns while supporting meaningful change. The true potential of private credit becomes even clearer when we look at how it's adapting to technology change. While traditional lenders often struggle with legacy systems and rigid processes, private credit managers can be more nimble, incorporating advanced analytics and data-driven insights into their lending decisions. This technology edge isn't just making faster decisions, it's about making better ones as well. Modern private credit managers can analyze vast amounts of data to spot trends. They can do it to identify risks and uncover opportunities that might not be visible through traditional analysis alone. This combination of human expertise and technological capability creates a powerful advantage in today's lending environment. But let's talk about something that often gets overlooked. Yeah, you got it, the human element in private credit. Unlike public markets where trading is increasingly automated, private credit success depends heavily on relationships and deep market knowledge. It's about understanding not just the numbers, but the people and businesses behind them. This human touch becomes particularly valuable when dealing with complex situations or when businesses face unexpected challenges. The beauty of private credit lies in how it brings together the best of both worlds. the potential for attractive returns and meaningful protections, all while supporting real economic growth. As markets continue to evolve and traditional investment approaches face new challenges, private credit stands out as a strategy that's built for today's financial landscape. In a world where financial innovations come and they go, private credit stands out not because it's new or flashy, but because it works. It's consistent. It works for borrowers who need flexible capital solutions. It works for investors seeking consistent returns with strong protections. And it works because it's built on a foundation of real assets, careful analysis, and direct relationships. Private credit isn't just an alternative to traditional investment. It's a testament to the enduring value of combining sophisticated financial expertise with fundamental principles of lending. In a world of increasingly financial complexity, that might be its greatest strength of all. If you found this overview of private credit valuable, make sure to hit the subscribe button, turn on the notifications so you don't miss any of our upcoming videos. Thanks for watching this video. I'll see you in the next video, and you can access it right here. Take care.